Months 6 to 12 are going to look very exciting to you because the first few months you've learnt all the theory, you're putting in small trades on long calls or long puts, you're understanding the game, you've mastered the theory at least, and now it's becoming very interesting for you because you're going to really get into options trading at this point. And you've learned the basics about option spreads. You're ready to put one contract trades on option spreads. We're talking about the bull call spread, the bull put spread, the bear call spread, and the bear put spread. So these are going to look very exciting because you're going to feel much more confident about yourself. You've taken this learning process in a very step-by-step methodical manner. And so you're gaining confidence, and that's the whole point, because the whole point is you should not lose your money when you're learning, because you still don't understand many aspects of how these options are going to behave. Suddenly, if you have a very high VIX environment or a very low VIX environment, certain strategies are going to skyrocket and certain strategies are going to fall on their face. And you may not have a full appreciation or understanding for those kind of subtleties and those kind of nuances yet. So that's why I keep mentioning that focus on this learning. There is no option trader on the planet who has learned all of this within 6 months. I can guarantee you that. This is the normal process for everybody. But the problem is most people don't realize that there is so much to learn and they blow their account. And that's what you should not do. So if during the first 6 to 12 months you've not lost any money, or perhaps you just lost a little bit, that's okay. And that's really, you're coming out ahead of 90% of people, because almost 95% of people who learn options, they lose money in the first year. Their first year is a disaster for many people. And truth be told, I've learned by making mistakes. I've learned it and I've taken some courses and things like that. But this aspect of not knowing what you don't know it's a human aspect, and it applies to everybody. We all do that. And that's why I want to hammer it in, so that it stays on the top of your mind, and hopefully it'll remind you not to make these mistakes. It'll remind you about how strong the learning curve is, so that you can focus on the learning, put in small trades. I'm not saying do paper money all the way, because that's not going to help you. What's going to help you is put small contracts, but be aware of all the moving parts in options trading. That's the real key. So once you've come through months 1 through 6 and you've learned option spreads, you're now getting into a very, very desirable position, because like I said, option spreads are the centerpiece. And if you can master the art of adjustment of option spreads, then you've learned the game. Okay, so let me back up here and let me explain 3 legs of the stool, what I call 3 legs of the options game. These 3 legs are critical to master. If you don't master any of these 3 legs, you're going to be in trouble. All right, so the first leg is the option Greeks. All options are dictated by the Greeks. And let me quickly show you what I mean on the platform, because here we have the Thinkorswim platform, and what I'm going to do is let's take Apple options, and I'm going to show you what we mean by the Greeks. Here you can see them for every option. So Apple's currently trading at 458. These are the various strike prices, and if you're not familiar with any of these, please don't be scared of them. It takes just a couple of days to get familiar with all of this stuff. So these are all option prices, and like we said, options are mathematical. So everything is dictated by formulas. So whether it's time decay of your option, or how volatile your option is, or how much your option price is going to move for a certain movement in the underlying stock. All of that is dictated by mathematics. So here we have a column called delta. Here we have a column called gamma. So these are all, these are your Greeks, your delta, gamma, theta, vega. And you need to know for each of these options, if you create a spread. So for example, let me create a single option, and let's see what that looks like. So here, if we wanted to buy a call option, say for example, I'm going to hide my positions. So all we're doing is simulations. So let's say we were going to buy a call option, and this particular call option is going to have its own Greeks. So, and that's what the Greeks will look like. You have delta, gamma, theta, vega, and you need to understand what all this stuff means. If you just put on a call option thinking, oh, I'm going to be bullish, so I'll buy a call option because I've heard that call options will profit if your stock moves up. Well, yes, it's true, but it may not always work out like that, because there are other parameters that determine whether an option price is going to go up or not. And those are time and volatility. And time is dictated by the Greek theta. Volatility is dictated by the Greek vega. So you need to understand how these numbers impact your position. So these are the option Greeks. This is one critical element, and this is one leg of the stool. Like I said, you need all three legs, and if you're missing any one leg, well, you know what will happen to the stool. It's going to fall. So the first leg is option Greeks. The second leg is risk graphs. So I use the example of a pilot. If a pilot wants to go from A to B, fly a plane from A to B, he needs to have a map. He needs a map to tell him where to go. So that's your risk graphs. You need to understand how these graphs work, because for every options position, you're going to have a risk graph. So I could add another trade here, and if I add that trade, it's going to change my risk graph. So you need to understand how to interpret this risk graph. You could add 5 different positions, and I can sell a vertical spread here, and you need to understand how it impacts your position. So your risk graphs are going to change based on your position, and the risk graphs will show what your position will do for readings of these Greeks. So whenever you add or subtract positions, all your Greeks are going to change, and that's going to be visually shown to you on these risk graphs. So you need to understand how to do that. And the map also involves tweaking or simulating your trade. So here you can see today's date is Feb 19th. You can move the calendar up or down, and that's going to change your position. You can see that all these numbers are going to change. So what you're doing is you're simulating time decay. So you can see all your option prices are changing. So as time goes by, how is your position going to fare? So that's what you're simulating here. Similarly, you can simulate based on volatility adjustments, on the stock price. There's all kinds of simulation possible here. So that's your second leg, the ability to interpret the map. The map consists of your risk graphs and your simulation windows and your simulation results. So that's your map. That's what tells you where you need to go. And the Greeks tell you how you're going to get there. So that's your instrument panel for the pilot. Without a reliable set of instruments, the pilot won't be able to get there. So that's what these things do for you. And you can see as you remove each of these trades, now look at this trade, you've got to understand what this means. Those are the 2 legs of your stool. One is the Greeks and one is the risk graphs. The third leg of your stool is option adjustments. Okay, this is a very critical part of options. It's a very unique characteristic of options that is not available to any other instrument in the markets. And that is when you take up an option position, you've taken a position based on a particular outlook, whether you had a bullish outlook or a bearish outlook, or you had a neutral outlook. You've come up with a strategy and you put in that trade. Now, nobody is a genius on this planet. Nobody can know whether, you might have created a nice strategy and a nice trade, but there's no saying that it's going to work out. Nobody on Wall Street can tell you whether your trade is going to work out or not, whether their own trade is going to work out or not. It doesn't work that way. You might have thought out your strategy and you put out a very well thought out, well planned trade. Perfect. But the market may not agree with you. So whatever your outlook was, the opposite might happen. So what are you going to do? In the stock market or the futures market, in any other market for that matter, if you buy a stock and it goes down, you're going to lose. What are your options, or other bad pun, what are your alternatives in the stock market? If the stock goes against you, what are you going to do? There's only a couple of things you can do. One is you can take advantage of the lower prices and add to your position so that your dollar cost averaging your stock price. In general, you can do that once or twice, but if it continues to go down, then dollar cost averaging is not a very good strategy. It's been proven. It's not a very good strategy. You could sell your stock, but all you'd be doing is booking your losses. Or you could hold on to your stock and all you'd be doing is looking at your losses. So those are your only alternatives in the stock market. With options, that's not the case. You can turn around a position. So let's say I'm going to buy a call option. Let's say I'm going to buy this call option. I'm buying 10 contracts of this call option. That's what my risk profile looks like. So which means if Apple was to go up, I would make a profit. Okay, fine. But what if Apple goes down? You can see I'm going to face a loss. So if Apple is continuing to go down, what are you going to do? With options, you can do any number of things. You can do any number of things. You can sell this call and turn this into a bear call spread. Or, let's take that out. Or you can buy a put option which will increase in value as the stock is going down. And see what that does to your risk profile. Now, it doesn't matter if it's going down or it's going up. As long as Apple makes a big move, you're going to make a profit. So my point is, you have various adjustments you can make to your options. If you're losing on a particular position, you can stop the bleeding. You can turn around and change your loss-making position to a somewhat break-even. Perhaps you'll take a little loss, but at least you have the ability to try to come back to break-even. And in many cases, you're going to be able to turn a losing trade into a winning trade. It's very possible. That's precisely what options are. You can, because you have so many strike prices, so many strategies, and so many different things going, that you're easily able to turn around a losing position and turn it into either a winner in some cases, or at the very least, you can attempt to come to break even on that trade. So the art of adjustments. So adjustments are an art. Okay, you obviously, to know how to adjust and what to adjust with, you've got to have a very clear understanding of all the Greeks and the strategies and all of that. So, I hope you're getting the message that there is a lot to learn in this thing. So I don't want you to be in a hurry, because if you're in a hurry, you'll lose your money. So that's the third leg of the stool. So in months 6 to 12, this is really what you're trying to master at this point. The art of adjustments, the art of knowing the pluses and minuses of all the different strategies that are out there, of all the different options that are out there. So you need to have a very good handle on these things. And so that's what your months 6 to 12 are going to be focused on. And during this time, you're going to try some of these advanced characteristics. So now what I'm going to do is, so I'll explain a couple of these strategies, but I think you'll get the picture that these strategies are going to take time. Okay, so but these are very powerful strategies. Some of these strategies are very powerful, and you don't have to trade in all of these strategies. Every person has automatically likes one or two of these strategies. So for me, I like iron condors and I like back spreads. Others would like calendars, they might like straddles, whatever. But you'll find that one or two of these strategies will be your favorite. And you can repeat those strategies on a month-to-month basis. Every month you put on these strategies. You have to become an expert in one or two strategies. Let me put it that way. Because all these strategies are very different from each other. And the mechanics of adjusting them in case things go wrong and bringing them back to sea level is an art. And because these strategies are so different from each other, you're going to have to learn the specific, the deep down, drill down mechanics of each of these trades. And it's not possible to learn for all of the trades. So one or two of them will automatically become your favorite, and you've got to learn how to adjust those trades. And once you've learned that, then you've acquired the skill. It's over. It's done. So then you can spend more time. So beyond month 12, then it's just a matter of trying to learn more. There is always a lot to learn in options. It's a never-ending sort of a process. But ideally, what you're going to do is income strategies, which I'm going to cover in the next lecture.